In 2008, the world's financial system came within days of collapse. Banks failed, millions lost their homes and jobs, and a crisis that began with mortgages in the United States spread across the entire world.
Let's kick things off with Section 1, the boom and the bait, the easy money era. So if we rewind back to the early 2000s, things were pretty wild. We had this incredibly loose monetary policy, and thanks to the repeal of parts of the Glass-Steagall Act, the firewall that historically separated boring, conservative commercial banks from high-rolling investment banks was basically gone. This just completely opened the floodgates for massive institutional risk-taking. And to fuel the resulting housing boom, well, lenders started aggressively targeting lower-income homebuyers with what are known as subprime mortgages. Now, these were highly dangerous products. They were pitched to borrowers with poor credit histories, mostly by luring them in with these super low initial teaser rates. A family might sign on to pay just 1% interest for the first year or two, making the home look totally affordable. But lenders were completely ignoring reality. They knew full well that these families simply wouldn't be able to pay when those teaser rates inevitably jumped up to 5% or higher down the road.
Moving into Section 2, the securitization machine, and how Wall Street repackaged risk.
So, what did Wall Street do with all these dangerous loans? They effectively transformed that localized risk into global financial weapons. It was all about the originate-to-distribute model. A broker would originate a toxic subprime loan and then immediately offload it to Wall Street. Investment banks would take thousands of these bad loans, toss them into a blender, and bundle them together into incredibly complex financial instruments called mortgage-backed securities, or MBS, and collateralized debt obligations, CDOs. But here is the absolute craziest part of all of this. The credit rating agencies, the very institutions whose sole job was to evaluate risk, inexplicably rubber-stamped these toxic bundles with their absolute highest rating, AAA. They were telling the world these things were as safe as U.S. government bonds right before selling them off to yield-hungry global investors, pension funds, and foreign banks.
To really grasp how convoluted this got, just look at the securitization flow for institutions like the UK's Northern Rock and its Granite Master Issuer vehicle. It perfectly illustrates the utter insanity of it all. Notice how the assets were actively shifted off the main books and into these off-balance sheet special-purpose entities. These complex structures basically slice the debt into different tranches, entirely masking the underlying toxic risk from the global investors who were eagerly buying them up. It was a system that allowed an almost infinite amount of bets to be placed on a finite number of housing loans, a complete house of cards. Which brings us to Section 3, cracks in the foundation, and the moment the housing bubble finally bursts.
See, this whole massive system relied on one crucial thing: house prices endlessly inflating. As long as prices kept going up, subprime borrowers could just constantly refinance before their teaser rates expired. But the music eventually has to stop. Between 2004 and 2006, the Federal Reserve started raising interest rates to curb inflation. Suddenly, borrowing costs skyrocketed, adjustable rate mortgages reset to those higher payments we talked about, and mass defaults began. The warning signs were literally flashing red, yet they were largely ignored. Well, ignored by most. In May 2005, fund manager Michael Burry saw the underlying rot and made a famous $60 million bet against the subprime market. Fast forward to 2006, housing prices officially hit their peak. Then, the dominoes started falling. In August 2007, the French bank BNP Paribas shocked the market by freezing its funds due to toxic assets. This triggered a massive credit freeze, which led directly to panicked depositors lining up down the street in a run on the UK's Northern Rock. That was actually the first bank run in Britain in over a century.
If you're enjoying these deep investigations into the events that shaped our world, subscribe to Golden Fern. Every week, we uncover the stories behind history's biggest moments, beyond the headlines.
Now we answer Section 4. The month the world broke, September 2008.
September 2008 was the terrifying climax. It was the moment that ticking time bomb of toxic, repackaged debt finally detonated. In a rapid-fire collapse, major historic institutions crumbled in literally a matter of days. By early September, the massive government-sponsored mortgage giants, Fannie Mae and Freddie Mac, failed and had to be essentially taken over by the U.S. government. Then, on Monday, September 15th, the truly unthinkable happened. Lehman Brothers, a massive Wall Street titan, filed for bankruptcy, and the U.S. government deliberately chose not to save them. That shocking bankruptcy completely destroyed whatever trust was left between banks. Because no one knew who was secretly holding the toxic debt, banks just completely stopped lending to each other overnight. Days later, the U.S. government was forced into an $85 billion emergency rescue of the colossal insurance giant AIG. Why? Because AIG had insured hundreds of billions of dollars of those failing mortgage securities, and if it went down, it was going to drag the entire rest of the financial system down with it.
Next up is Section 5, Contagion, the global panic and the ensuing bailouts. The terrifying reality was this panic could absolutely not be contained to Wall Street. Because those toxic CDOs had been eagerly sold all over the globe, we were now dealing with a financial contagion that instantly infected stock markets everywhere. This wasn't just an American housing problem anymore. We were literally looking at a global economic heart attack. Charlie Bean, who was the deputy governor of the Bank of England at the time, summed up the sheer terror perfectly. He called it, quote, a once-in-a-lifetime crisis, and possibly the largest financial crisis of its kind in human history. By October 2008, the Indonesian stock market had to halt trading entirely after a massive 10% drop in a single day. The Icelandic stock market plummeted a staggering 77%, and its top 3 banks collapsed completely. Stock markets from London to Tokyo were in absolute freefall.
So to stop the bleeding, central banks and governments had to launch unprecedented, massive interventions. We're talking coordinated global interest rate cuts, bringing them down to almost zero. In the U.S., Congress pushed through the $700 billion Troubled Asset Relief Program, or TARP. This violently injected taxpayer liquidity into the markets, bailing out major banks and even automakers like General Motors and Chrysler, honestly, just to keep the economy breathing. On top of that, the FDIC bumped up deposit insurance from $100,000 to $250,000 to stop any more bank runs, and the Federal Reserve essentially created emergency loan facilities out of thin air just to restart the frozen credit markets.
And finally, Section 6, the fallout. We'll look at the devastating human toll and the post-crisis reforms.
You know, beyond the mechanics of the crash, beyond the credit default swaps and the boardroom panic, the real story here is the devastating human toll. Look at the sheer scale of the loss. Nearly $6 trillion in housing wealth simply evaporated in the United States alone. Think about that for a second. While Wall Street executives were busy debating bailouts, ordinary people were suffering immensely. Millions of homeowners were foreclosed upon and evicted from their homes. Workers lost their jobs as businesses, completely starved for credit, were forced to shut down. And the life savings tied up in global pension funds decimated. It was a massive transfer of immense financial pain directly from the wealthy risk-takers to the everyday public.
In the wake of this incredibly deep recession, public trust was completely shattered. As a result, governments around the world were forced to introduce sweeping financial reforms. In the United States, the most notable of these was the Dodd-Frank Act. These reforms attempted to increase regulation on that shady shadow banking sector, restrict banks from making speculative bets with their own money, and strictly increase capital requirements. Essentially, this meant forcing banks to keep enough actual cash in the vault to ensure they could survive future shocks without relying on the taxpayer to bail them out again.
Was the 2008 financial crisis caused by greed, weak regulation, risky lending, or a combination of all three? If you enjoyed this documentary, please like the video, subscribe to Gold and Fern, and let us know in the comments which story we should investigate next. Thanks for watching, and we'll see you in the next documentary.